Well, welcome to today's webinar from Bob Binney Wealth Management. My name's Bob Binney.
I'm Jessie Thompson.
Jessie's my daughter, if you don't already know, and works with me here and our other staff at Bob Binney Wealth Management. Our topic is Investing 101, basic investment vehicles. And we're just going to start with the basics and kind of go hopefully explain some things about how different investments like stocks and bonds and et cetera work. And go ahead and take it away, Jess.
We'll answer any questions anybody has at the end. The way you can ask a question is by typing it in a box, usually depending on what you're using, cell phone or computer. It's usually at the bottom of your screen is where the question box is if you want to type in anything as we're going. We also want to remind you that any webinar we do, we put the replay up both on our website at bobbinney.com and on our YouTube page. If you look up Bob Binney Wealth Management on YouTube, we have replays of all of the webinars that we've ever done. And those usually go up about the day after we do the webinar. And we have a bunch of short clips as well. If you don't want to digest an entire webinar, but there's something that you missed that you're interested in, check that out too as well.
Yeah, I know all of you already know about this, but this YouTube's kind of a big deal. And one time we had a YouTube thing, we kind of went viral, didn't we, Jess? Sort of, in our own sort of way. We thought we went viral. Anyway, but I'll move along with that. So regarding these investments, pretty much all investments can be categorized into one of two types. Where am I? One of two types. Either ownership investments or loanership investments. So the ownership investments, you're owning things like pieces of companies with stocks and mutual funds and whatnot, or real estate or commodities or gold, precious metals. Those are ownership. You're actually owning something. And the value of the investment goes up or down, or the value of your account goes up or down with the value of that particular equity that you own. The loan investments, you're loaning your money out. So when you go and take your money to the bank, whether it's in a checking, savings, CD, whatever, you're loaning your money to the bank. They're going to pay you a little bit of interest on that and then loan your money out to somebody else and they make the spread. It's the same thing with bonds. A bond is just more of a direct way. Whether a bond is a loan to the government, you're loaning your money in a municipal bond or in a corporate bond, it's a loan. And just keep that in mind, owning versus loaning. And historically, the financial markets, and it makes sense, have always rewarded long-term ownership better than loanership. Loanership is safer, but it's not really safer in some situations, like when you're in really high inflation like this. Ownership investments are where you want to be, because loan investments are always going to lag inflation in their returns.
So the four basic types of investments that we're going to be talking about in today's webinar, the two most basic kinds of investments are stocks and bonds. We're going to go over those first, and then we're going to also talk about mutual funds and ETFs, which are kind of hybrid investments or mixed investments. So we'll get into all that. But first, let's talk about stocks.
So the first thing that comes to mind when people think of investing as stocks, the stock market. Let's just explain what stocks are. A stock is simply a piece of a company. These large companies or a smaller company, like my company, I could have 2 shares of stock and you could have 1 share and I could have 1 share. But these great big companies that are worth, $100 billion or $500 billion or even $100 million, most people don't have money where they can, the kind of money where they can buy the whole company, so they can buy a piece of the company. And so that's what all a share of stock is. And so when you own a share of stock, you own the company. You don't have total control over the company. You only have control over the proportion that you have, but you get voting rights and all that sort of stuff. And your stock share, that piece of ownership, can go up or down in value based on a number of factors.
And so here are a few factors. Well, It's a pretty
ton
good
of
list
factors.
of factors that can cause the market to go up or down. And again, this is a lot of things.
Causes an individual stock to go up or down.
Or
The
right.
whole market, right.
Right. And so there's a lot of things that come into play with the value of a stock, but in its simplest, it comes down to there's kind of two different ways to value a stock. So there's the true value, and let me just explain this chart really quick. So over here on the left is price, over here on the right is time. The blue line is intrinsic value, which means the true value of how much your piece of the company, the stock that you own, is worth. And the intrinsic value, the true value, is in blue. The value of a company goes up based on how profitable they are, as far as the earnings that they're reporting right now, and how profitable that they're expected to be in the future. And so you can see this line over time. If a company is managed well and they're successful and they're doing well, they might have some ups and downs, but their value, their true value, is going to go up over time. Well, this red line is the market price of your piece of that company. And that's a lot more volatile because that's based on things like supply and demand, things like investor sentiment, things that are going on in the news, whether people are feeling fearful or confident in this particular company or the particular industry that this company is a part of, things like that. And that's going to go up and down a lot more than the true underlying value of the company is going to go up and down. And so there's going to be times where the actual price that the stock is buying or selling for is lower than the actual true value of the company. At that time, the company is undervalued and it's a really good time to buy. There's also going to be times where the price of the stock is valued way higher than what the true value of the stock should be based on their earnings and profitability. And at that time, that stock is overvalued, and that's not a good time to want to buy into the stock, even though that's what a lot of people do, because that's the time that they feel most confident either in the market or in that company. So that's kind of a brief explanation of how price works with stocks.
That's great. And it reminds me of some stuff I've been reading. In fact, I read today that the stock market right now, where we are right now, even though it's gone up quite a bit this year, still is not overvalued relative to earnings. In fact, it's undervalued relative to earnings compared to how it was at the last stock market high before the big drop. So this is a good time this is not just because the market's gone up, 15, 20, whatever percent based on the index you're looking at this year, this is still a good time to buy. Companies the stock market as a whole is undervalued or correctly valued relative to earnings. They're not overvalued. That's what I'm trying to say. So there's different types of stocks or companies, and with the different, for instance, you can categorize companies on company size: large, medium, and small. Larger companies are generally more often less risk. Smaller companies are more risk. You've got their location, whether they're United States companies or foreign-based companies. Generally, United States companies are less risk. And then you've got their the category of company regarding strategy. What are called value companies, are companies that pay out a portion, maybe a significant portion of their profits in dividends. And then you've got companies that pour all of their profits back into the company to continue to grow. The value companies generally are a little bit less risk than the growth-oriented types of stocks.
So stocks, of course, inherently have risk, but these are some ways that you can mitigate risk in a stock portfolio, is by using large companies that are US companies that are more strategized. Is that a word? Strategized towards value or a blend instead of growth. So there's also different sectors of stocks or of companies.
Sectors.
And these different sectors typically perform better during different times in the economic cycle. And so, for example, during recession, utilities, consumer staples, and healthcare typically performs better than some of these other things like technology and consumer discretionary, which are things that sectors that typically do better during times of economic expansion and growth and peak. Same with real estate. And so the reason that we mention this is that it's very important in the stock market when you're using stocks to diversify a portfolio. So if you're diversified across these different industries, then when different things happen in the economic cycle, you're not going to be, if we go into a recession, your portfolio won't be completely torn apart because you're diversified and include things that do well during a recession. Whoops.
What happened there?
I got too far ahead of myself.
Are we okay?
Yep.
All right. So individual stocks can carry a lot of risk, and many things can happen that can cause a company to go down in value, such as government legislation. Their true value
that we were talking about
like
earlier.
Government regulations and higher corporate income taxes, bad business decisions, etc. But where was I going with this?
Well, we're talking a little bit more about diversification.
Yeah, we're talking about diversification. So you can, mostly for our clients, most of our investments that we manage are put in ETFs, exchange traded funds of indexes and things like that. Very few individual stocks, but you can, diversify away the individual risk of any individual company by owning about 15 or 20 different stocks. But there's, advantages and disadvantages about that, as far as then you have to watch those 15 stocks. But if you're willing to, you don't have to have, because we have people sometimes come in here and show us their portfolio that they've got from somebody else, and they have 100 stocks in there or 50 stocks.
And there's like $1,000 or $500.
You can't keep track of it. You can't keep track of that.
That's not very effective diversification, but you only need 15 to 20. And we'll talk a little bit more about more effective ways to diversify here in a little bit.
But one of the benefits, a big benefit of the stock market or ownership investments in companies, is it's the best historical hedge against inflation. And it just makes sense. So if you think about what inflation is, and that's the biggest risk we all have right now, is this high inflation. You think about what inflation is, it's the rising cost of goods and services. Well, logically, the best A grade and the best hedge is to own the companies who produce and sell the goods and services whose prices are rising. And it's just not just logical, but it's proved itself out in history. When we had super high inflation before, in the late 70s and early 80s, the stock market was by far the best hedge, the best of categories of investments to hedge against that.
And another benefit of the stock market, there's always a trade-off. So the stock market does, yes, have a fair amount of risk, but it also has the highest potential returns of the investments that we're talking about today, or I guess versus bonds. And that's something that's essential when we're thinking about retirement income for people too. If you're going to have to take out, 4 to 5% of your portfolio annually, which is what the average retiree has to take out, they need something that can, one, keep up with inflation, and two, keep up with their withdrawals. And that's something that you basically have to be invested in the stock market in order to do. So let's move on to our second investment vehicle, and that is bonds. So we'll talk a little bit about how bond works. Bonds are issued by either the government or corporations to raise money. And so a corporation, we'll just use in this example, say a corporation wants to raise some money. They are going to issue a bond. The bond is then purchased by you or me, an investor. And then the company promises to pay interest on the bond in the form of coupon payments. And those are fixed. They pay you twice a year. And then at the end of the promised term, so you'll have a term of, I don't know, 6 months to 30 years on some bonds. They promise that they're going to pay you the original amount that you loaned them back. So in the meantime, they're paying these coupon payments to you as interest for the loan.
So if I can interject or add this, so let's say it's a $10,000 bond and the interest rate on the bond, let's say it's a 20-year bond, $10,000 bond, the interest rate is 5%. They're going to pay $500 a year on that bond. And then at the end of the 20 years, they're going to pay the $10,000 back. So in the meantime, though, you can sell the bond for its fair market value. And we're going to talk about that in a little bit, aren't we?
Yes, we are.
Okay.
Yep. We'll get to that in just one second. But like I said earlier, the bonds are either issued by the government, and that can be the federal government in the form of treasury bills or treasury bonds. And these are historically, or these are thought about as some of the safest investments that you can be in because they're backed by full faith in the government to pay you your money, pay you the loan back at the end of your term. Or municipal governments, local governments, you might have heard these described as tax-free bonds, because if you live in the place where the bond is being issued, those bonds are tax-free, both at the federal level and at the state level. And then the other
type of bond is corporate bonds. That's how they borrow money rather than going to the bank. A lot of times a corporation will issue bonds.
Mm-hmm.
So let's move on. Well, all right. So here's where I was starting to talk about earlier. So interest rates and bond market values have an inverse relationship. And so if interest rates go up, bond market values go down. If interest rates go down, bond market values go up. And I show people this teeter-totter with my hands. And so, like if interest rates are over here and bond market values are over here, if interest rates go down, the bond prices go up. It has no effect on anything unless you sell the bond. If interest rates go up, bond market values go down. So if you can go back to the screen then. So, and longer term bonds are more sensitive to interest rate income adjustments. So in other words, if it's a 3-month bond, an increase in interest rates is going to have zero effect on the bond, hardly. But if it's a 30-year bond or a 20-year bond, an increase in interest rates could cause that bond to drop in market value, by 5, 10, 20%. So the point of this is, or part of my point is, if you hold a bond to maturity, you get all your money back. But if interest rates go up and you need to sell your bond, you're going to sell your bond at a loss. And that's why right now is probably not a real good time to be buying bonds or even to be owning bonds, unless interest rates stop going up. And I think they're going to keep going up. So
some of the benefits of bonds is that, like we talked about, they've been traditionally held as more conservative investments than the stock market. So they're not going to see typically as much price volatility as stocks do. Bondholders are also in line ahead of stockholders if a company goes under. So the bondholders will get paid back before stockholders get paid back. We talked about that government bonds are guaranteed by the US government, so they're typically seen as very safe investments. And then also municipal bonds, local bonds, are tax-free.
Right. And so the risks of bonds, obviously there's always a default risk. You're not going to have much of a default risk on some kind of bonds like government bonds, but you can certainly have a default risk on a corporate bond. If a like a big corporation like Bed Bath and Beyond's going bankrupt and whatever, they might default on their bonds. But if it's a solid bond, that's not your biggest risk. The risks I want to talk about are interest rate risk. So the interest rate risk on a bond is that if interest rates go up, the market value of your bond goes down. And doesn't matter if you hold the bond to maturity, but if you own a bond fund and that bond fund is full of bonds,
Mutual fund, which we'll talk about in a minute.
And interest rates go up, your investment went down. You can't hold a mutual fund of bonds to maturity and make out. You're going to get killed or hurt when interest rates go up. So a second category or a second type of risk with bonds is reinvestment risk. That's the risk that when your bond matures, you're not going to be able to reinvest the bond at as high of an interest rate as what you were getting. And then huge risk right now for bonds is inflation risk, because bonds are right now and historically usually are never pay higher than inflation. So just like cash, CDs, and bonds, all three of those are going to lag inflation. You may be getting 5 or 6% on a CD or a bond, but if inflation is 10 or 15%, you're going in the hole.
Right. Okay, so we're going to move on now and talk about mutual funds and ETFs. First, we're going to talk about mutual funds. So both mutual funds and ETFs are baskets of investments. And so they're a basket of either bonds and or stocks that are pooled together. And so there's two different kinds of mutual funds. There's managed mutual funds and index mutual funds. In a managed mutual fund, there is a fund manager that is actively buying and selling stocks and or bonds in the mutual fund, trying to optimize performance to beat the market. Okay, those are typically more expensive because you have to pay this manager to do their job. Then there's also index mutual funds, and index mutual funds are a basket of stocks and or bonds that are bought and held to track a particular index or a particular sector, things like that, a particular section of the stock market or the bond market. So for example, the S&P 500 in an index fund, that fund would just buy the companies in the S&P 500 weighted to reflect what the S&P 500 actually looks like, and they just hold on to them. And those are less expensive because they don't have a manager having to pick the stocks or pick those and buy and sell within the fund. We like index funds better, and the major advantage of index funds is performance. So if you look over the last 20 years, actively managed mutual funds, which are more expensive because again, you're paying a manager, actually underperformed the indexes that they're compared to, the indexes they're trying to beat. 92% of the time, they only actually beat those indexes 8% of the time. So historically, it's been more effective to just buy an index mutual fund that reflects the actual index than pay more for these managed funds.
Well, it's kind of like when we found out about this several years ago, it's kind of like a light went off over my head. Because at that time, the number was around 80%. Only 20% of the mutual funds beat the indexes. And so all of a sudden the light that went off over my head was, wait a minute, if I just buy the indexes, I just beat 80% of the other mutual funds. And so that's pretty good.
So the same risk factors that we talked about with both stocks and bonds, of course, are going to apply to mutual funds because it depends on what underlying investments the mutual fund is in. If it's a stock mutual fund, then it's going to have the same risks that stocks have. But the major advantage of a mutual fund is that you have built-in diversification. So kind of like we talked about earlier, that you need, maybe 15 or 20 stocks to diversify a portfolio. Well, there's many stocks in a stock mutual fund. So you have already spread the risk just in one stock mutual fund across many different companies. And so
like hundreds.
Yeah, a lot of them have hundreds of companies. So you have all of this built-in diversification, and you can actually fully diversify a portfolio with only 3 to 6 mutual funds if you choose them right, which is really awesome and really simplifies things as well. So another thing that I wanted to touch on really quickly about mutual funds that's a little bit different as far as the pricing goes, because you can buy and sell mutual funds anytime during the market day, but you're not going to buy or sell them for the price at the time that you choose to buy or sell them. The price that you're going to get is an end of day price. And how it works with the pricing of mutual funds is, at the end of the day, that mutual fund is going to add up all of the values, the end of day values of all of the stocks that they're invested in. And then they're going to divide that by the amount of shares in the mutual fund, the amount of people that have invested in it. And then that's how they're going to get their end of day price. And so if something is going on that's a market sensitive thing that you really want to get in or out, and a lot of other people have the same idea as you, you might be in for a little bit of a surprise at the end of the day.
You're going to get the end of the day price.
Yep.
So the other kind of category of pooled stocks or baskets of stocks that we wanted to talk about besides mutual funds are exchange traded funds. That's the abbreviation for that is ETFs. And so they're very much like these index mutual funds that we were talking about. There are some managed ETFs, but we don't deal with those. But the exchange traded funds are technically and legally structured as stocks themselves, not as mutual funds. And so they can trade any second of any business day, unlike a mutual fund that.
And you get the price at that second.
Yeah, so that's a little bit of an advantage. If you wanted to get in or get out of an ETF right now, you can do it right now because the market's open. If it's a mutual fund, you're going to get the end of the day price. The other thing, because they trade like stocks, is you can place special orders on them, including a thing called a stop loss order. A stop loss order is an order that you place on a stock or an ETF that says, if the price drops to this price, I want to sell. They're kind of being like a parachute. So like if the price today is 100 and you're nervous that the stock market is going to have a big crash and you don't want to wait until after it goes down a bunch to get out, you could place a stop loss order at 95 that says that if the market price during a day gets down to 95, it sells you, and it sells you automatically. So those are two kind of little advantages. Another one that's an advantage is that you typically have lower expense ratios than most mutual funds. The risks of an exchange traded fund are generally the same as whatever the underlying investment is of the type of stocks that they are. They have the same benefits as mutual funds with stocks anyway, but without some of the drawbacks of being able to having to sell at the end of the day and that sort of thing.
So that closes us on today's webinar topic and the basic investment vehicles. We hope that gave you a little bit of a better understanding of maybe what's in your portfolio and how it works and what kinds of things would be right for your portfolio. So if you have any questions, ask them now. Otherwise, we're going to close up. It doesn't look like we do.
Well, we invite you to, if you do have any questions that come up, you can email me at bob@bobbinney.com or Jesse at bobbinney.com, or you can call our office at 402-421-2626. But we're here to help people, and we help people with their investments, managing their investments, with planning income for retirement as they're getting ready for retirement or in retirement. We help people with tax strategies to minimize their taxes, we help people with estate planning. And our goal is just to help you. And if we can be of help to you, or you or a family member or a friend, please give us a call. Have a blessed
Thank you
day.
very much.